Now that we have a quorum, the committee will come to order, and we will. I suggested the committee was. Did it work? Okay. Now that we have a quorum, the committee will come to order, and we will begin the executive session on the committee's budget resolution. I move to approve the committee's budget resolution by voice vote. If there's no discussion, all in favor say aye.
Aye.
Those opposed, nay. The ayes have it. The resolution is adopted and is hereby ordered reported to the full Senate. I ask unanimous consent that the staff be allowed to make technical and conforming changes and that the cordon rule be waived. Any objection? Hearing no objection, so ordered. The executive session is now adjourned and we will proceed to the hearing. I'd like to invite the witnesses to come sit at the table. Thank you. Good morning, and thank you all for being with us today. We're here to address an issue that strikes at the core of what it means to live in a free and fair society: access to financial services. Every federally legal business and law-abiding citizen deserves to be treated equally, regardless of political views or ideological leanings. This is an issue that is deeply personal to me. When my grandfather was growing up in the Jim Crow South, banks did business with people they felt looked the right way, based on the color of their skin. One's ability to get a loan to finance their home or start a business was based primarily on the color of the skin. And in the 1940s, my mother experienced the same redlining that has been persistent, pervasive, and unfortunate for decades. Thankfully, our nation continues to evolve in the right direction. And in the 1990s, when I was starting my small business, I went to a bank and looked for an opportunity to get a loan. I'll say without any question, at that time, as a kid growing up in poverty in a single-parent household, my best asset, Mr. Ricketts, was a 1990 10-year-old car with 253,000 miles. One would not consider that an asset, perhaps a liability, but it was my only means of transportation. And I will tell you without doubt, for me, it was an asset. The bank, however, completely helped me understand it was not. However, in those days, someone could get a character loan because of your time in a community, because of your relationships with local and community banks. And because of that, not only was my financial life changed, not only did my American dream become a reality, but more importantly, my mother's American dream became a reality. We saw the strengthening of confidence in our banking system because things had changed in the right direction. With that loan, everything seemed to get better. Had I not gotten that line of credit, I may not be here chairing this committee today. You see, my story is so consistent with so many other stories that really reflects positively on the American dream. In this country, access to credit is one of the cornerstones of building your American dream. Owning a home and starting a business are challenging journeys filled with complexities, and achieving success is never a guarantee, nor should it be. That's why access to financial services is so important. The United States is home to a vast competitive network of banks and payment providers, creating one of the most robust, diverse financial services ecosystems on the planet. It is this incredible landscape that offers countless opportunities for homeowners and entrepreneurs to build a healthy foundation and make strides towards achieving their version of the American dream. However, it is incredibly alarming and disheartening to hear stories about financial institutions cutting off services to digital asset firms, political figures, and conservative-aligned businesses and individuals. Under the Biden administration, We've seen the rise of what many are calling Operation Choke Point 2.0, where federal regulators exploited their power, pressuring banks to cut off services to individuals and businesses with conservative dispositions or folks aligned with industries they just didn't like the color of one's skin in my family's history. I wholeheartedly believe that debanking someone over their political ideology is un-American and goes against the core values that our nation was founded upon. Today, we'll have an opportunity to hear from Anchorage Digital's CEO, whose OCC chartered bank was debanked. Old Glory Bank's CEO, who started a bank to serve those who had been debanked, and from a legal expert with extensive experience navigating these regulatory abuses, and from a policy expert at the Brookings Institution. This hearing will also examine how practices similar to the original Operation Choke Point have persisted, despite assurances that they would end. We'll investigate the role both regulators and financial institutions have played in these harmful practices, which hurt not just businesses, but also consumers and our entire economy. This issue should concern every single American, regardless of political affiliation, and that's why I'm committed to a bipartisan solution to stop this form of discrimination. This hearing is just the beginning. We are here to shine a bright light on these unacceptable practices and to hold those responsible accountable. The message is crystal clear. No regulator and no bank is above the principles of fairness and market access. Speaking of shining a light, I was so glad to see that just a couple of hours ago, the FDIC, under President Trump's leadership, released a fresh set of never-before-seen supervisory documents, which further proved that Choke Point 2.0 was real. I will be going through the documents in greater detail, but rest assured, for those in this room and those watching at home, they paint a disgusting and disheartening picture of abuse. As Acting Chair Hill characterized them, these and other actions sent the message to banks that it would be extraordinarily difficult, if not impossible, to move forward with crypto-related activities. I commend the new FDIC leadership for its commitment to transparency, but it is a shame that it took an election for the agency to begin following the laws of our country. Thank you. I look forward to hearing from our witnesses and working with colleagues on both sides of the aisle to stop debanking and protect every American's right to participate fully in the economy. Ranking Member Warren.
Thank you, Mr. Chairman, and thank you for holding today's hearing on debanking. It's a real problem, and it's something that I hope we can work on together. People need access to a banking account in order to thrive in today's economy, and the same goes for businesses. Without a banking account, you just really can't get along. Debanking happens when a bank shuts down a customer's bank account because they think that that account poses a financial, a legal, or a reputational risk to the bank. Once the bank shuts someone out, the bank may share that information with companies that get paid to maintain a do not bank list, with the result that the customer is blacklisted everywhere. For me, this is straightforward. It doesn't matter who you voted for, what you believe in, or the origin of your last name. People shouldn't be arbitrarily denied access to their banks, locked out of their accounts, or stripped of their banking privileges. To help identify what's going on, my staff reviewed the Consumer Financial Protection Bureau's complaint database, looking for cases where consumers reported that they were unable to open accounts or that their accounts were wrongly closed. Classic debanking. Mr. Chairman, we put together a supplemental memo on this data, and I'd like to make that part of the committee record.
Objection.
My staff identified 11,955 complaints, and that is only the people who took the time to file complaints, and only during the past 3 years. All of these complaints reported common themes: no warning, no explanation, and no chance to dispute or appeal. These people described how one day, all of a sudden, they lost their place in the banking system. We know from the Consumer Complaint Hotline that millions of Americans of all political stripes have had the same experience. Tens of millions of customers have been blacklisted by the banking industry because they overdrafted their account a few times. Formerly incarcerated Americans have been debanked because of their criminal history. Some people have even been debanked merely for having the same name as someone who has a criminal history. Muslim Americans and Armenian Americans have faced debanking on account of their last names. Nonprofits and charities operating internationally have been debanked through no fault of their own. Lawful cannabis businesses have been unable to open accounts, and employees of those businesses have been debanked. This shouldn't be happening, and we need to figure out why and who is responsible. My staff did some more work here as well. They found that just 4 big banks, Bank of America, JP Morgan, Wells Fargo, and Citibank, accounted for half of all the complaints filed at the CFPB. Donald Trump was on to a real problem when he criticized Bank of America for its debanking practices. Banks may be taking shortcuts when it comes to assessing risks. Rather than investing the time and the resources to identify true criminal risks and shutting down those accounts, big banks are relying on black box algorithms and middlemen companies and shutting down accounts without doing careful due diligence. We can prevent these abuses. I know that the Consumer Financial Protection Bureau is a favorite whipping boy of the Republicans on this committee, but the CFPB is the main agency in our government that is actively working to stop unfair debanking. Let me say that again. The CFPB is the one agency that is actively working to stop unfair debanking. Right now, the agency has 5 different rules, either in place or in progress, that would help prevent debanking by addressing some of the root causes, from overdraft fee practices to religious discrimination. And the CFPB is working to hold banks accountable when they close law-abiding citizens and businesses' accounts for no good reason. I sent a letter to President Trump today that walks through the CFPB's work, and I'd like to make that part of the committee record.
Objection.
I said that the CFPB is the one agency fighting back against debanking, but that may be at risk. Earlier this week, Treasury Secretary and acting CFPB Director Scott Bessent halted all CFPB rulemaking, enforcement, investigations, and litigation against financial institutions that are breaking the law, including the banks that are wrongfully debanking their customers. The freeze Secretary Bessent put on the CFPB means more Americans across this country will be unfairly debanked, and they will lose the one agency that is working to help them. There is additional work to be done by the Treasury Department, the Federal Reserve, the FDIC, and other regulators to issue clear anti-money laundering rules and guidance for banks to follow. which would reduce the incentive to use debanking as a form of risk management. Mr. Chairman, I'll say again, I appreciate your holding this hearing. Debanking is a real problem. I'm eager to work with you and President Trump to support the CFPB's efforts to make sure that everyone is treated fairly and that we put an end to this debanking.
Thank you, ma'am. I now recognize our first witness, Mr. Nathan McCauley, CEO and co-founder of Anchorage Digital. You may begin your testimony. Thank you for being here.
Thank you, Chairman, Ranking Member, and distinguished members of this committee for having me as a witness today on the important issue of debanking. My name is Nathan McCauley. I'm the CEO and co-founder of Anchorage Digital, an institutional crypto platform that is home to the nation's only federally chartered crypto bank. I grew up in Economy, Indiana, a population of about 150. Though I came from what many call flyover country, and one of my first jobs was grilling burgers at McDonald's, I had big dreams. I want to be a computer engineer and entrepreneur. Early in my career, I worked on cryptography as a security engineer. In 2017, after being asked for years by friends to help them manage the private keys to their crypto wallets, my co-founder and I decided to start a company to offer a safe way for institutions to custody their crypto at scale. That company is Anchorage Digital, with about 400 employees around the globe, including 282 employees across 37 different US states, and offices in South Dakota, New York, Portugal, and Singapore. While we started out as a state trust company, I believe that our company, clients, and the industry would benefit from the highest regulatory standards. So we chose to pursue a national bank charter under the OCC that would allow us to offer crypto custody, staking, settlement, and other services to our institutional clients. We received the charter in January of 2021, the first and still only of its kind. Today, we are privileged to safeguard billions of dollars worth of crypto for institutions ranging from crypto protocols to asset managers to sovereign wealth funds. I'm here today to talk about something I could not have imagined when I started this company, not in America. That is the story of how we were virtually shut out of the federal banking system, despite being a federal bank ourselves. Since January of 2021, we held a corporate bank account with a partner bank, which held client fees from custody and other services, along with general corporate funds for day-to-day expenses like payroll and administrative expenses. One day in June of 2023, we received an urgent email from the bank saying they needed to speak with us that day. On the call, they told us they were closing our account in 30 days because they were not comfortable with our crypto clients and their transactions. They refused to provide any further explanation or allow us to speak with the risk management team. Needless to say, I was shocked. We had had a positive relationship with the bank for nearly 2.5 years. Not once had they raised any issues with our account. In fact, at the time we were told our account would be closed, we were in active talks to expand our relationship into new partnerships. Separately, following the closure of the banks where we held our capital reserve and fiat sub-custody accounts for our clients, we had extreme difficulty finding new bank partners. We spoke to about 40 banks across the country and were rejected by all of them, many telling us that they had a blanket policy against serving crypto clients. So why did this happen? I believe that regulators pressured banks to shut an entire industry out of the federal banking system. Why do I think this? Two things. A series of crypto regulatory actions spanning from 2021 to 2023, and my own lived experience. First, in my written testimony, I go into great detail about the long list of anti-crypto regulatory actions that led to mass debanking of our industry. But in my view, the nail in the coffin was the joint statement from the Fed, FDIC, and OCC in January of 2023, warning national banks from serving crypto clients or engaging in crypto activities of their own. Second, I want to talk about my lived experience. Outside of what happened to our company, I'm an investor in 4 crypto companies that struggle to obtain and keep their bank accounts. During this time, some of them actually had to shut down. Further, I have at least 2 employees that have debanked because of what they believe is associated with the crypto industry, including one as recently of December of last year. Finally, I have spoken to dozens of crypto leaders that have been debanked personally or had their crypto companies debanked. While Anchorage Digital was eventually able to find banks willing to partner with us, the impact of nearly being shut out of the banking system was devastating. It was extremely disruptive to our business and our clients, and contributed to the very difficult decision to lay off 70 employees here in the United States, about 20% of our staff. To this day, our clients lack the ability to send wire transfers to third parties, a basic banking service we previously had access to. Furthermore, it abruptly ended opportunities to provide sub-custody to other national banks who are actively exploring partnerships with us. The irony of having trouble accessing the federal banking system, despite the fact that we ourselves are a federally chartered bank, cannot be overstated. Congress is right to investigate what happened to us and our peers across the industry, to protect and promote fair and open access to banking services for all law-abiding citizens and companies. Thank you for the opportunity to appear today, and I look forward to answering your questions.
Thank you, sir. Mr. Stephen Gannon, partner at Davis Wright Tremaine, you are now recognized.
Good morning, Chairman Scott. I thank you and the other members of the committee.
Hit your button.
Thank you, Mr. Chairman.
Yes, sir.
And good morning, and I thank you and the other members of the committee for the opportunity to address you on the matter of the underlying policies, processes, and norms that have allowed debanking to continue. I'm a partner at the law firm of Davis Wright Tremaine, and for 20 years prior to that, I was a senior legal executive at several large banks and bank-owned broker-dealers. Debanking has come to my attention, both in my in-house roles and in private practice, as a lawyer who represents both banks and digital asset firms. Debanking, of course, is not new. This committee is familiar with the unfortunate history of Operation Choke Point 1.0, in which former FDIC Chair Bill Isaac described it as one of the most dangerous programs he had experienced in his 45 years of service in the government and the private sector. The committee also has seen examples of debanking, both this morning and in the record. One more may illustrate the challenge posed directly to banks by virtually unbound supervisory discretion. A small bank had been making tax refund anticipation loans. Those loans were legal then, and they're legal now. The FDIC, however, instructed it to stop that business. The bank refused. And according to a report by the FDIC's OIG, the bank and its tax preparers then became the subject of a special horizontal review, staffed by 400 FDIC examiners. I'll now address the building blocks used by regulators to engage in debanking activity. They depend on broad, vague, and malleable terms, always subject to reinterpretation by supervisors. You could call it strategic ambiguity. For example, reputation risk does not relate to the financial condition of a bank, but rather on how an examiner perceives the reputation of the bank. And because reputation risk can impact any aspect of bank management and bank risk, it is literally everywhere and subject to unlimited discretionary judgment of bank examiners. And in the same vein are terms such as safety and soundness and risk of future harm. Finally is the term management, the M element of the well-known CAMELS rating system. Unfortunately, management has come to mean almost anything the supervisors find to be unacceptable, regardless of whether there is an impact on the financial health of the bank. And a poor management rating can have disastrous consequences for a bank's business going forward. Compounding the problem, this kind of arbitrary discretion is not subject to meaningful challenge. Supervisory examinations are shrouded in secrecy and are not available for any effective review by the very banks whose information is being analyzed. Bank regulators contend that everything done within the envelope of an examination is confidential supervisory information, and that CSI is the property of the regulator itself, even though that argument rests on weak legal and constitutional grounds. The digital asset industry has felt this impact with great intensity. For example, in 2021 and 2022, using interpretive letters, each banking agency promulgated an unusual prior restraint requirement called a supervisory non-objection before any bank could engage in permissible crypto activities. Notably, these letters met the definition of a rule under the Congressional Review Act, but they were never submitted to this body for review under that law, and no bank has dared to disobey their mandates. This exercise of nearly limitless regulatory discretion suffers from a fundamental problem. It distorts the relationship between a regulatory agency and Congress. Under Article 1, the entirety of an agency's power is delegated to it by Congress. Not some of it, all of it. If an agency wishes to make a legal business illegal, it must ask Congress for that power. Debanking of legal businesses ignores that fundamental concept and also contravenes this administration's recent executive order stating that regulatory agencies are to, quote, protect and promote fair access to banking services. The good news is that there are a series of remedies that can be implemented, some starting even today, as we discuss in our written statement. But while those remedies look forward, it cannot be stated strongly enough that the challenge remains to provide full and complete remedies for those already harmed by banking. Commentators wrote after Operation Choke Point 1.0 that we have to demand that accountability and those remedies, or we risk setting a terrible precedent that ideology can control our regulatory agenda at the expense of banks and small businesses alike. But despite the best efforts of Congress, the spirit of Operation Choke Point 1.0 did not end in 2017. It simply morphed into Operation Choke Point 2.0. Mr. Chairman, history teaches us that if this time there is no real accountability and no genuine remedies for the actual damage done, one thing is certain: there will be an Operation Choke Point 3.0. Thank you.
Thank you, Mr. Cannon. We'll turn to Mr. Michael Ring, President, CEO, and co-founder of Old Glory Bank. You are now recognized. Thank you.
Thank you, Chairman Scott, Ranking Member Warren, other members. Thank you for having me and allowing me to share the story of Old Glory Bank, which launched from beautiful Elmore City, Oklahoma in April of 2023 and became a market solution to debanking. And Chairman Scott, we are a community bank that does do character loans, and we would love to have your business. Nathan, we have a program on being the on and off ramp for crypto, and we would love your business.
Do you have one for law firms?
You bet. We got. I'm honored to speak on behalf of our more than 50,000 customers across all 50 states, our 88 passionate employees, and our pro-America co-founders, including some of them here today. We've got radio and TV host Larry Elder with us today, future governor of California, I hope. We've got the 27th governor of Oklahoma and former two-term member of Congress with us, Mary Fallon Christensen. We've got one of our other co-founders, former co-president of Fox News and the White House Deputy Chief of Staff of Communications for President Trump's first term, Bill Shine with us. Of course, we have our brilliant and beautiful Chief Legal Officer, who's also my wife of 20 years, Anne Marie Ring. And the two of our co-founders who could not be here today are former Secretary of HUD, Dr. Carson, and America's favorite patriot, country music icon, John Rich. And hopefully he's tweeting right now talking about this. I want to also thank Mr. Wade Christensen, who's with us today from the great state of Oklahoma, whose family previously owned the bank we purchased to launch Old Glory Bank, and who are now co-owners at the bank. So, as we've heard today, lots of debanking going on, and there's two types the way I define it. There's the regulatory type of debanking, which other folks much smarter than I am will talk about, and there's Operation Choke Point 1.0, 2.0, and there's probably some 2.5 in there somewhere. And then there's participant debanking, which is where the big banks debank you. So other folks will talk about the regulatory, but I just want to remind folks, it cannot be a coincidence that in April of 2022, both the FDIC put out FIL 1622 and the SEC put out SAB 121. There was clearly, those are big organizations, there was clearly working together to choke out not only banks acting as a custodian for other people's customers' crypto, but to stop the demand deposit services of a bank. And if a crypto company can't provide that on and off ramp, you choke out the business, and that is what has happened in America. But the more interesting part of it is the participant debanking. And that is the voluntary effort by the big banks to debank Americans who disagreed with them on the issues we all know, whether it's COVID, the vaccines, or who supported Donald Trump, including his wife, who was debanked, as we know, and other conservative causes. And I don't know the First Lady, but I can assure you she is not a money laundering risk, and she was debanked. The founders of Old Glory Bank saw what many of us saw. But instead of sitting around and complaining about it, we all got together and created Old Glory Bank as a market response. We purchased a one-branch bank in beautiful Elmore City, Oklahoma on November 30th, 2022, and just 5 months later, working hard, we launched the best digital-first banking service in America. In less than 2 years, we grew from $10 million in deposits to now over $170 million in deposits. We grew from 300 customers in Elmore City to now more than 50,000 customers across all 50 states. We serve over 2,000 small businesses. We have respectfully better products than the mega banks, but our service is in Durant, Oklahoma, not offshore. Our customers love us, and we love our customers. As part of our market solution, in less than 2 years, we had to do a 360-degree approach. We had to do our own version of cancel-proof PayPal called Old Glory Pay. We had to launch a cancel-proof version of GoFundMe called Old Glory Alliance. We launched Old Glory Cash In so our customers can walk into one of 88,000 locations across America and deposit cash. You always talk about the friction point of banking online. How do you deposit cash? We solved that with Old Glory Cash In. We are serving Middle America. And the one I'm most proud of is Old Glory Protect. We have a free $100,000 line of duty death benefit for our protectors. God forbid they're killed in the line of duty. John Rich and I show up at your house and give you $100,000 if you bank at Old Glory Bank. And the protectors are a big group: law enforcement, military, firefighters, including volunteer firefighters, and importantly, U.S. Border Patrol agents. We all know debanking is wrong, but I believe the simple solution is a market solution, not regulatory, with all respect. We've got to make it easier for banks to start and run. I'll close with this. In the last 2 years, 229 banks closed, or were merged. Only 8 were started. We've lost 73% of our banks in the last 40 years. It is not sustainable. We have got to make it easier to start and run banks. Thank you.
Thank you, sir. Next, we'll hear from Mr. Aaron Klein, Senior Fellow at Brookings Institution. You are now recognized.
Thank you, Chairman Scott, Ranking Member Warren, members of the committee. Thank you for the opportunity to testify on the pernicious consequences of debanking in America. All of the views I offer here today are my own. 10% of American households are currently unbanked or were unbanked at some point within the last year. Not having a bank account adds significant costs, makes people less healthy, and makes it impossible to fully participate in America's increasingly digital economy. People are debanked because the cost of basic banking is too high. There are unpredictable fees, banks don't offer the services they want, there's a lack of trust in banks, concerns about privacy, and problems opening an account due to identification or bad credit histories. Checking accounts are free for those who always have money, while those living paycheck to paycheck pay a myriad of fees that can easily reach over $500 a year, making basic banking unaffordable. My written testimony illustrates how debanking harms consumers and businesses and enumerates ideas for reform. I want to highlight 5 proposals to combat debanking. First, require all banks to offer and credit unions to offer bank-on style accounts. Bank-on accounts are affordable, low-fee, non-overdraft accounts that are wildly popular among consumers and are considered a best practice by the American Bankers Association. Why should any federally insured bank or credit union not be required to offer a best practice account? 2, reduce penalties and surprise fees that debank the financially vulnerable. Most of America's largest banks and many small banks and credit unions voluntarily reform their overdraft practices. According to my estimate, that will return $5 billion a year into the pockets of people living on the financial edge. But many did not. The CFPB's overdraft regulation recognizes the economic fact that overdraft is credit and treats it accordingly. That rule should be allowed to go forward. However, the rule erred in not in exempting banks and credit unions under $10 billion, which includes many institutions whose overdraft practices ought to raise serious concerns. I'll mention one, Armed Forces Bank. They generate $92 of overdraft per customer compared to just over $1 of overdraft per customer from Bank of America. How is that bank, or any bank, that generates a majority or totality of its profit year after year on overdraft, operating in a safe and sound practice? Regulators need to treat it as such. 3, we need to improve the design of the financial system to better serve working people. How can Amazon get anything to almost anyone's door faster than it takes 2 banks to transfer an electronic funds? If America had instituted real-time payments when England did, people would have saved over $100 billion in overdraft fees, check cashing fees, and payday loan fees alone. You know, 70% of people go to a check casher, have a bank account. Why are they at the check casher? Because the check casher gives them cash immediately. The bank doesn't. The Federal Reserve has been required by law to lower the amount of time a bank can sit on your check, and they have ignored the law for 37 years. Even when the past CFPB director called for modernization, legislation introduced by Senator Warren and Senator Van Hollen, the Payments Modernization Act, would hardwire this into law and fix this problem, and would be the most effective thing I can think to combat debanking by improving the quality of services banks offer to people living on the edge. 4, reform AML. When Congress established the $10,000 CTR limit in 1972, you could walk in and buy a fully loaded brand new Cadillac in cash and not trigger that report. Today, Mr. Scott, I don't know if your used car would trigger a CTR.
I'm not sure it would trigger anything, but thank you very much. Yes, sir.
If you adjust that $10,000 limit for inflation, you'd be over $75,000 today. Why is Congress, what's the government doing looking at things at such a different level? In addition, banks filed 2.5 million suspicious activity reports today, an increase of 10 times more than they did 20 years ago. Banks spend a lot of money making SARs, and they pass that along to consumers and small businesses. And the result in economic terms are low-profit customers get pushed out, high-profit customers keep their bank account. Look at Japanese baseball star Shohei Ohtani. He got to keep his bank account despite somebody fraudulently impersonating him and wiring $17 million into the account of a bookie. That person kept their account, but plenty of low-income people, as Senator Warren pointed out, 11,955 people lost their account. It has to do with the economics here. States need to, there's a cannabis banking issue that deals with SARs as well, where I hope the Safe Banking Act, which was a good step forward, but needs to go further. Lastly, 5, we need to reform these do not bank list systems like CheckX, where you get kicked out for being just poor, not for fraud. The Bank On program has helped solve that, and that ought to be done across the board. I thank you all for holding this important hearing, and I look forward to answering your questions.
Thank you, Mr. Klein. I'll start the questions, and then we'll head to the ranking member, and we'll go back and forth. Mr. Ring, the Biden administration took several actions that likely contributed to the debanking of crypto firms. In January 2023, the prudential regulators issued a joint statement urging banks to limit their exposure to cryptocurrency activities and associated risks. The FDIC-IG disclosed that the existence of pause letters sent to financial firms between March of 22 and May of 23, asking them to pause planned or ongoing crypto-related activities and provide additional information. And as I said earlier, we received validation today with Chair Hill's actions. The SEC issued Staff Accounting Bulletin 121, which effectively prevented banks from holding digital assets in custody. These actions collectively helped create an environment where banks became reluctant to work with crypto firms, fearing regulatory backlash. You've worked to create a banking environment focused on being a home for so many Americans and businesses who have been debanked. I'm hoping you can share what your interactions have been like with our federal banking regulators.
Well, I like to say that I'm standing between the regulators and America, and I'm the only bank executive who is not intimidated by the regulators. And I definitely fly too close to the sun, but you've got to protect America. And what was really disappointing about FIL 1622 that you referenced, Chairman Scott, is that on its face, if you read it, it wasn't entirely unreasonable about safety and soundness. Unfortunately, the examiners took that to stop banks from even being the on and off ramp. So if you're a legal crypto business, it's one thing that there could be some challenges holding a customer's tokens and keys, but to think you could not be that legal business's bank account was the real problem with FIL 1622, and thank goodness it's been exposed. SAB 121, I don't know how that passed the laugh test. To think that if you're holding a customer's crypto, that you've got to book that as a liability and then put capital against it is ridiculous, and thankfully that's been rescinded.
Thank you for that answer. Mr. McCauley, Anchorage Digital has the honor of being the only OCC-related federally chartered crypto bank in the United States. This stamp of approval from the OCC should provide your company with legitimacy and access to traditional banking services. However, as you detailed in your testimony, Anchorage has still struggled to access the traditional banking system despite you're a bank. This is unacceptable. Could you elaborate on Anchorage's debanking experience and the impact on your business operations, including making payroll for your employees and going beyond the 20% layoffs? Devastating for any business. Our employees are very much like our families when you're in business, and I'd love for you to share, in addition, other issues and challenges that you face because they don't want you to be a bank.
Senator Scott, thank you for the question. I think the first effect that was so pernicious about the debanking that has gone on for the last several years has been the kind of betrayal of the bargain that is the American experiment. We were taught growing up that we would have a fair legal system and a fair justice system, that we could face our accusers. And so I would say the most devastating part of this to the crypto industry has been that betrayal of trust. And I think that as we look forward to the new administration coming in and thinking about the path forward here, that is probably the most important thing to reestablish is this industry's trust in the reliability of the American banking system and the legal and justice system here.
I would suggest it goes to the entire government. Anytime you see the weaponization of government against you or your industry, it makes you not just cautious, but leery of the entire system itself. I wonder if you would, because of your day-to-day interaction with so many crypto firms, how widespread is debanking in the crypto space?
So an anecdote I could share is I was speaking at a meetup of about 100 crypto founders within San Francisco, and just as a show of hands, I said, "Hey, who here has had trouble getting a bank account or has had debanking issues?" All the hands in the room went up. And so to say this is pervasive is an understatement. It's been across the entire industry. Everybody has dealt with this. In fact, it became so commonplace to us that it became background noise. And we started thinking about it. It was just assumed that if you were a crypto company, you would have trouble getting banking services.
Unbelievable. Ranking Member Warren.
Thank you, Mr. Chairman. So debanking is a real problem, and we need to work across the aisle to solve it. I've got a stack of stories sent in by consumers and organizations that were debanked. I'd like to submit them for the record. Thank you, Mr. Chairman. These stories are from Muslim Americans, from cannabis businesses, from formerly incarcerated individuals, all of whom lost their bank accounts for no apparent reason. So I want to talk about what kind of recourse consumers have or don't have when they are debanked. Mr. McCauley, you testified that your company lost its bank account when you tried to open a new one. Dozens of banks, including some of the biggest banks in the country, turned you down. Which of the big banks refused to offer you an account?
Senator, I don't think it's productive to name individual banks. I believe the banks were the victims here.
Okay, I just wanted to get it into the record because we have recourse. Did you get an opportunity to appeal the decision with any of those banks?
No, Senator, there was no room for discussion with the banks.
So no appeals at all. You know, that's unfortunate. The CFPB has accepted 11,955 complaints from consumers and organizations that were unable to open accounts or their accounts were wrongly closed just in the last 3 years. Do you agree that it's useful to have a database for this information so that we can identify trends, both the types of individuals or businesses that are targeted and also the banks where this is happening?
Senator, more data and more transparency will help.
Okay, good. You know, I don't think for a second that you should be locked out of our banking system. In many cases, it is wrong for banks to close accounts and threaten your ability to make payroll or pay rent on time without even providing an explanation, so long as you are following the law. So, Mr. McCauley, do you agree that people who are illegitimately debanked deserve some rules to protect them and an appeals process if they lose their accounts?
Yes, Senator. Something should be done to make sure that regulators do not do this again.
Okay, and if banks are adopting policies that routinely debank people based on their beliefs or other illegitimate reasons, that's wrong. It needs to be stopped. Mr. McCauley, should consumers be protected from being debanked based on their political or religious beliefs?
Yes, Senator. Many individuals within the crypto industry were debanked, and I wish agencies had helped them.
And I presume you would carry that over to people who are debanked for other reasons as well.
Of course.
Because of their beliefs. You know, the CFPB has been on the front lines of combating debanking for years now. In 2022, they added debanking to the list of illegal practices that bank examiners should be on the lookout for. Last year, they wrote rules to crack down on debanking by payment apps and the third-party data aggregators that the banks use to decide who to kick out of the financial system. Just last month, they proposed a rule to stop companies like PayPal that had considered fining users for certain types of speech on their platform. Mr. Klein, how would the CFPB's rules help put a stop to unfair debanking?
Well, Senator, the CFPB is really on the forefront of looking for consumers, making sure consumers have access to high quality and fair banking practices as opposed to the bank regulators who are too often focused on the bank. I can think of 5 rules that the Bureau has: their contract rule, their UDAP or unfair discriminatory practices rule, their larger participant rule, which would give them authority over places like Venmo and PayPal, which you just described, their data broker rule, which includes credit reporting agencies like this CheckX system that maintain a de facto do not bank list, where again, there's no economics to require those things to be accurate. It's simply a limited appeal process, and their overdraft rule, because when you ask people who've lost their bank account or are out of the banking system, why don't you have a bank account? The number one reason is it's too expensive. And their overdraft fees, which some estimates were up to $30 billion a year or more, are part of the large reason people leave. So those 5 rules the Bureau have put out would all combat debanking in various ways.
Thank you. The CFPB is ready for this fight. And every day that the CFPB is locked out of doing its job, people are getting debanked. If the president is serious about stopping debanking, then he needs a strong CFPB as his partner to get this done. Thank you, Mr. Chairman.
Senator Rounds.
Thank you, Mr. Chairman. Well, I think as many of you can see in this room, the different directions that we're talking about here in terms of the direction that we need to go. Some of us are interested in having the regulatory oversight actually be identified as the problem here versus suggesting that the big bad banks are suddenly doing this all on their own. Let's walk our way through this. Mr. McCauley, it's good to see you again. I'm glad that you decided that South Dakota was the right home base for you when you started the state-chartered trust facilities that you've got. You shared with us the challenge that you had in getting banked. First of all, you are the first and only federally chartered crypto bank, correct?
Yes, that's correct.
And Anchorage Digital is both a qualified custodian and has a conditional OCC bank charter. What's the nature of the accounts at the other banks? Checking accounts?
Basic checking accounts and holding our capital reserves. And then further, we, as a conditional charter, hold cash for our clients at partner banks.
So, any of that illegal?
Absolutely not.
So you ever overdraft?
No.
So, in other words, it's not a reason, it's not a case of a business reason why anybody would want to not do business with you, other than the fact that you were a crypto or you would hold crypto in trust for other people, and that was a no-no.
That's right. And to put a finer point on it, the bank that debanked us was actively trying to work with us more.
But for some reason, there appears to be a point at which they said, we can't do this with you anymore. Was it because they didn't want to bank with you? The answer to that is no, that wasn't the case. What was the case? What was it?
They wanted to bank with us, and many of the other banks that we reached out to after that bank account was closed also wanted to work with us. This was consistent across the board that banks did want to work with us, were not discriminating against us, but they were worried about regulatory risks.
So you weren't doing an illegal activity like cannabis, which is federally illegal to do, and you weren't overdrafting. You were simply part of a legal industry that banks were told by regulators would be a problem for the bank. Is that correct?
That's right. I'm a bit of a square. I like rules. I like following rules, and so we've always followed all the rules and regulations.
Mr. Gannon, thank you, sir. Mr. Gannon, you've represented financial institutions. Are you finding that these banks simply don't want to do business with people, or is it a matter of, for people that will follow the law, that aren't violating the law, and that are not business risks of simply overdrafting their accounts, these banks want to look for business, but because of a regulatory environment that they have been in, they have been forced to decide whether they want to do business with certain types of industries, whether they were gun manufacturers, people that sold guns, people that did the terrible thing of being in the business of crypto activity and so forth, were now suddenly being identified because of the type of business that they had, which was a legal business, by regulators who are coming down hard on them. What can a regulator do to a bank that doesn't want to comply with their demand, whether it be written or implied?
Senator, the regulators can do quite a bit. The banks are not making this up. They like to have customers, like all businesses like to have customers. Regulators have a lot of tools subject almost to their complete discretion. And
Supervisory in nature.
supervisory tools.
The auditors walk in and say, guess what? You got a problem. A camel rating might change, correct?
Correct. Like
What happens if a camel rating changes for a bank? Let's say it goes from a 2 to a 3. What happens? Do they get bonded?
that, they don't. That's a very, very bad result, Senator. What happens is you're pretty much locked out of any ability to expand. What you pay for your FDIC insurance goes up, and there are a lot of other strictures on what you can do as you go forward and attempt to grow your business. So that really is the big hammer that the regulators have. And management rating can be almost everything. One of the things that's remarkable is if you look at the Fed's supervisory report from November of 2024, you will find out that they say 2/3 of the large banks in the United States are not well managed. Those same banks, and we have a chart on this in our written statement, those same banks have record levels of capital and liquidity. And I can tell you, Senator, they also invest enormous amounts in technology, in community reinvestment, et cetera, perhaps higher than any time in history. Yet somehow 2/3 of them are not well managed.
Thank you.
That doesn't make a lot of sense.
Thank you. Mr. Chairman, I just really appreciate your taking the time to have this hearing, and I think the focus of what's happening to banks who want to do business with legitimate businesses and the struggle they've had with a supervisory approach for the last couple of years, which has put pressure on them for what they consider to be inappropriate types of legal businesses, and this has got to stop.
Thank you, Mr. Reynolds,
you,
and
Mr.
thank you for
Chairman.
your questions. They were illuminating. Senator Reed.
Thank you very much, Mr. Chairman, and thank you all, gentlemen, for your testimony. One of the factors involved in this discussion is reputational risk, because that's often the justification for the actions and rules of the federal banking regulators. And last year, we had a very positive discussion about the Safe Banking Act, and I worked with my colleagues to come up with a compromise that would still allow reputational risk to be a factor, but to put up some guardrails with regard to its application. And Mr. Kine, can you elaborate on the importance of maintaining reputational risk as a factor in evaluation and also the guardrails that might be in place?
Yes, Senator. I think the compromise that was worked out in the Safe Banking Act on reputational risk effectively addressed that problem. Look, at the end of the day, all banks are a reputation-based business. Trust is the cornerstone of all banks. Consumers trust that the banks have their money, and when a bank loses trust, it has the possibility to have a run on it. So the need to consider reputational risk is real, and it is important. It is possible that it is abused, and you need to have guardrails on it. But it is absolutely a certain and important part of bank regulation and supervision.
Thank you. Mr. Ring, I know you understand this very well because in your offering circular back in 2024, you've specifically pointed out the dangers of money laundering and terrorist financing. And one of the aspects of crypto, it's a rather new phenomenon, is that it seems to be a very often used vehicle for financing of places like North Korea, financing of illicit activities. Does that put more pressure on you to be more stringent and regulate, and also the regulators to be more careful of watching what you do?
I believe the Bank Secrecy Act, which is what you're talking about for AML, and by the way, for folks not in this room, the Bank Secrecy Act has nothing to do with the secrets and has nothing to do with your customer data. It is strictly about money laundering and those rules what you're talking about. I am not in favor of the amount of delegation law enforcement has done on banks with respect to these type of issues. They're real issues, but banks should not be on the front lines because what happens is that is the Trojan horse for banks to do whatever they want. Oh, it's AML, BSA issues. Or the regulators to come in and say, you can't do crypto because of that. If you're checking out at a grocery store, does the cashier and the bagger have to let the police know you bought some chemicals? Of course not. And so I believe it's the Trojan horse. It should be a small component of the issues you're worried about with crypto.
Well, again, I think the bank regulators are trying to react to a relatively new phenomenon. Crypto is about a decade.
It shouldn't take 10 years, respectfully.
No, but it's a situation in which, looking from my perspective in national security on the Armed Services Committee, North Korea makes a lot of money through crypto operations, and a lot of these, as you point out in your offering circle, terrorist groups use it too. So I think there has to be a heightened awareness both in the industry and also within the regulators with respect to crypto. And that's a factor that's not as prominent in other banking institutions that don't deal with crypto.
I believe every bank has the same concern about AML and terrorist activities, and I don't believe that crypto is the overwhelming factor that the Bank Secrecy Act really, which is preventing, is going to solve what you want, respectfully.
Mr. Klein, you have a comment?
Yeah, I wish every bank felt the same way. I think one of the problems that we have in our anti-money laundering system is we've created an economic structure where the costs are very high, and the banks respond by saying, if you're a low-profit customer, we don't want you because of the AML cost. But if you're a high-profit customer, we'll just pay the AML fine. I mean, I can't understand how a foreign national was wiring $17 million in $100,000 increments, and I encourage you all to listen to read the DOJ's filing and listen to the audio that's been released of his interpreter saying, I'm paying $200,000 to this illegal bookie's bank account for a car loan, and maybe there'll be more. And that bank account was not closed. So I think that there's a very different world going on between very wealthy people, very wealthy businesses, and banks who see AML as a fine and a cost. Some, not most. But what I'm saying here is that we have an AML system where the economics of it are not in line with the objectives of it, which are to use this information to catch criminals. We're reporting too much information that's not useful, but there's too much criminal activity where banks are being let off the hook too easily just to pay a fine.
Thank you.
Thank you.
Senator Tillis.
Thank you, Mr. Chairman. Thank you for all you for being here today. Mr. Chair, when you were opening up, I was thinking about why I knew what a 90-day note was when I was 14 years old, because it kind of went like this. My dad did construction work. He had a relationship with a couple of agents, insurance agents, and when they had damage that was not of a major scale, that was my dad's work. And I was a 14-year-old helper that would be in the bank parking lot when my dad would go into a banker in Nashville, Tennessee that he had a relationship with and got a 90-day note. And that's what paid the bills for the project and ultimately put food on our table. We have all but over-regulated those personal relationships out of business. My dad today probably couldn't get that 90-day note because he'd have some supervisor breathing down the bank's back about how could you possibly give this man money that's living paycheck to paycheck and trying to feed 6 kids. We are over-regulating in a way that is debanking people de facto. Now, Senator Warren mentioned, well, people have been debanked because they bounced a check a couple of times. That's called that's called managing a risk. I'm not saying that they should not find a way to provide that person with help, but them having a consistent pattern of bouncing checks is not help in the long term. We need to figure out how to help them manage their finances, not force banks to carry an at-risk customer on their, in their portfolio. Now, if we talk about, and then we also talked about, and then you know, we've got the cannabis business. Well, the last time I checked, the cannabis business is illegal at a federal level. I, for one, think we should re-examine that. But we damn sure shouldn't do it by passing the Bank Secrecy Act, which makes it default legal before we've taken any firm position here that provides the industry with clarity. Somebody wants to work on rules of the road and do that and bank the industry in a cohesive, sustainable way that doesn't kind of skirt around the fact that it's still illegal at the federal level, count me in. Happy to do it. Now, I think we've got a lot of regulator-initiated debanking going on with this concept of reputational risk, Mr. Gannon. I think you've got people going into the banks, and I don't know, these gun people may not be, you know, these unsavory people, or you know, fill in the blank. Now, I will tell you, so I want your input on that, but let me tell you what I've told every GSIB CEO that's been in my office, and everyone has been, and their counterparts in Europe. I said, if you act like a politician, I'm going to treat you like a politician. You provide banking services, period. Now, if you have judged, as a CEO, if you have judged that you want to do a bank that only banks blind-headed, blue-eyed people, and there's a market opportunity for that and a growth strategy, knock yourself out. If you can prove to the investors and the shareholders and your entity that it is in the best interest of your bank and your underlying strategy to grow, fine. But we have clearly seen reputational risk being overused by bank supervisors, bank examiners saying, well, maybe you want to move out of there. And it changes depending upon who's in the White House. I don't think that that's right in either case. Banks should be able to figure out what they can do to derive value and serve their customers. Can you give me some examples or your thoughts on whether or not, Mr. Gannon, you believe that a lot of these debanking is a direct result of regulators kind of doing a wink and a nod, this is an unsavory segment to serve?
Senator, I do think that, and the reason is regulators have taken the term reputation risk and made it incredibly
It's overly
subjective.
broad. It's anything.
It's almost the definition of subjective. It's not really tied or linked to anything that's objective. And one of the things that I can tell you, having sat in planning sessions for some fairly large banks, is it's impossible to plan against that. When you don't know what the terms are of what your regulator and supervisor wants you to do, it's really difficult to come up with a plan.
The perverse consequence of all this stuff is it's costing banks more money, it's shutting down more market opportunities, and making it more difficult to continue to bank the people that just bounced a couple of checks. Because at some point, you're affecting the business plan, the underlying success of the business, and they have to close the aperture to the most profitable, most sustainable part of business. So I just feel like we need to, I'm here to talk about the regulator-initiated debanking. I'm not talking about other behaviors where people lose financial services. We need to have a hearing and a discussion about that. But I would like anything you can provide for the record on some use cases of debanking that, in your opinion, was driven by a regulator interaction. That would be very helpful. I'm sorry I don't have more time. Thank you.
We'll do that, Senator.
Thank you. Senator Warner.
Thank you, Mr. Chairman. I want to pick up on this question of reputational risk. I think it has been overused. I've been trying to push the banks to use the discount window more often before we add additional tools. That's out there. But the response is always, well, reputational risk. I do agree with Mr. Klein that banking is a reputation-based business. And if people start to lose confidence in that bank, they're going to move, whatever the regulator does or doesn't do. And that's why I got to ask, rhetorically at least, and perhaps to my colleagues, the United States dollar and the United States government and the full faith and credit are all build up the reputation of the United States of America. Now, if any of your institutions suddenly let somebody into your payment system that had no background in banking, that had no understanding of money flows, that suddenly gets an ability without any screening to look at all of your customers' personal banking information, I believe that would cause reputational risk. And that is in the United States Treasury at this moment in time. We don't know if the Doge crowd, there is one person that maybe has a clearance, the others, we have no fricking idea. But the ability, and we don't know for sure whether this is a read-only ability or read and write, which in past the legalese means that person could potentially go in and alter code or manipulate payments. I say to my Republican friends, guys, can't we agree that the risk of the United States is worth protecting? And the idea that we've got people potentially manipulating our payment system that we have no idea. And we're going to sit silently by? This isn't about efficiency. This is about the kind of payment system we're going to have in our country. If any financial institution let unscreened individuals into their payment book or into the private banking information about their customers, Mr. Klein, I believe their reputation would go straight to hell.
Absolutely, Senator. I worked in the Treasury Department for almost 4 years with a top secret clearance. I was going nowhere near that. And as you point out, this is not about efficiency. If you wanted to make the Treasury system more efficient, you would move it to a real-time payment network. Should have been done years ago. You wouldn't just sit there and take read access to look at every single payment the U.S. Treasury Department does. Any bank that did that to their customers would be in deep violation.
Well, it's also the fact that, the payment system in the Treasury, that's not where determinations are made about whether something is illicit or illegal. That is actually the subject matter expertise resides at the agency that has oversight. Yeah. I just say, come on, guys, this is about the full faith and credit of the United States. It is about our reputation in the world. You're getting the same calls that I'm getting. They don't identify whether they're Democrats or Republicans, but these programs that may or may not be arbitrarily eliminated by somebody that we don't even know who they are. Efficiency, sign me up. Turning over the payment system to people that we don't have any idea who they are or what their goal is or what their mission is, where we can't even get a full answer whether they simply have read capabilities or read and write. This is an enormous difference in those extra couple words. And I just feel, Mr. Chairman, this ought to be something that we as the Banking Committee that are looking at the Treasury, we ought to jointly want that. There's a 25-year-old there. I've read about him in the newspaper. I don't know the individual. I don't have the slightest idea if they got security clearances. I will tell you this. Mr. Gannon, I was going to ask you about something on crypto that I'm not going to be able to get to. I look forward to working with Senator Loomis on how we promote innovation but don't overdo on the risk side. And I think we can do much better than we've done so far. But I have to just tell you, as somebody that was chair of the Intelligence Committee and now vice chair and take that role incredibly important, the notion that somebody may be arbitrarily put out these payment flows for something that looks kind of funky, but they don't have any idea what it is, will hurt our national security. Because candidly, and this is not classified, we fund things sometimes under a cover. We put out this information, and the bad guys find out about this, people's lives are at risk. And I implore you all as experts, I implore my colleagues, this should not be a partisan issue. Let's get to the bottom of who these people are, what kind of clearances they have, and make sure that we don't put in further jeopardy the risk and reputation of the United States government, which I believe is under immediate and imminent attack from these unsanctioned individuals. Thank you, Mr. Chairman.
Thank you, Mr. Warner. Before I go to Senator Kennedy, I do want to respond to your comment there, Mark. The Treasury just put this out, Importantly, the ongoing review of Treasury systems is not resulting in the suspension or rejection of any payment instructions submitted to Treasury by other federal agencies across the government. In particular, the review at the physical services does not cause payments for obligations such as Social Security and Medicare to be delayed or rerouted. To be clear, the agency's responsibility is for making the payments, always drives the payment process. Currently, Treasury staff members working with Tom Kraus, a Treasury employee, will have read-only access. Just to
Mr. Chairman,
help some of
do
the
you know, Mr. Chairman, Mr. Chairman, I'd just like to ask.
Sure.
So you are saying that is read-only and not read and write?
That's what Treasury just.
And do you know the identity of these individuals? Mr. Kraus is a known quantity, and he's got security clearance. The other individuals who've been reported in the press, do they have security clearance, sir?
I'll just say this, and
Do you want that individual without security clearance to have access to all that information?
I was clarifying a comment you made, number one. Number two, I would simply say that under the Biden administration, we had no clue who was doing what most of the time. Mr. Kennedy.
Senator Warner is a reasonable man. Everybody on this committee knows that. And he's a good man. And I understand he's interested in process, and I'm not saying that process isn't important. But if the United States of America has been taking taxpayer money and using it to produce a transgender opera in Colombia, then I want to know about it. And I'm glad to know about it. And it seems to me that that's the main issue with respect to all of this. And I look forward to talking further with my friend, Mr. Warner, about that. I mean, for 4 years, under President Biden, as was his right, the topic of discussion in Washington was who needs to pay more in taxes? Who needs to pay more in taxes? That's no longer the main question. The main question is now, as it should be in my judgment, what the hell happened to all the money? And we're going to find out. Now, I need to get back to the subject. With the exception of Mr. Klein, whose testimony I enjoyed, I understand his position. He wants to let the CFPB run America's banks. And I appreciate that perspective, but Mr. Klein, it's not going to happen in your natural lifetime or mine. Now, let me turn to the other gentleman. What I hear Mr. McCauley, Mr. Ring, and Mr. Gannon saying is that some of America's banks have been discriminating, debanking customers because of their religious beliefs, because they support the Second Amendment, or because they hate fossil fuels. I don't want to go with all three of you. I'll run out of time. Mr. Ring, is that what you're saying?
Yes, sir.
Which banks?
Well, I think it's been publicly reported that Bank of America has certainly picked and choose winners.
Who else?
I think Chase Bank has.
Who else?
I think Citibank has.
Who else?
I think KeyBank has.
Who else?
I'm going to probably run out of names pretty soon, but I think the mega banks are. Old Glory Bank is not, of course. We
Well, then
love
we
the
need
Second
to-
Amendment and fossil fuels.
We need to get those banks in here, Mr. Chairman. We need to get all those CEOs in here.
I would agree.
Now, why? I appreciate your candor. Why do you think, are banks doing this because they're scared of the regulators? Or are they doing this because the people running the banks are prosecuting their political beliefs?
I think-
When a bank holds a seminar, taking up valuable employee time to discuss whether a man can breastfeed, Are they doing that because regulators are leaning on them? Or are they doing that because the CEO really thinks that's subject to debate?
I think it's definitely the latter, and I think it's also middle management.
What do you mean the latter?
It is not the regulators. I do not believe the regulators pushed the big banks to debank conservative
You
causes. I do not. I think it was their internal choice by these big banks.
Why?
Well, why, the same reason why big tech pick and choose winners. I think big banks pick and choose winners that they care about. And that's why we need a market solution, because you can't regulate that type of behavior without having unintended consequences. And now every time you get a customer application, you've got to fill out 5 forms as to why you did or did not pick that customer.
So you think that that's the management of these banks that are just imposing their own politics on customers and ultimately to the detriment of shareholders? Is that your testimony?
Yes, sir.
Either you two gentlemen in my last 10 seconds disagree with that?
I strongly disagree, Senator. Yes, I've spent a lot of time with a number of banks.
Who do you think it is?
I believe it's the regulators.
How about you, sir?
It's definitely regulators. All the big banks wanted to work with crypto and were scared away from it by the regulatory apparatus.
All right, I'm out of time. Thank you, Mr. Chairman.
Thank you, Mr. Chairman. Thank all of you for your testimony. Mr. Ring, you work hard to protect your customers' sensitive personal information, do you not?
Yes, sir.
And you wouldn't just turn it over to anybody who walked into your bank, would you?
No.
And Mr. McCauley, I assume the same is true for you.
Yes.
So I do want to bring up this issue that Senator Warner raised, because what we are witnessing right now in real time is Elon Musk going into the Department of Treasury and demanding access to highly sensitive personal information that could impact any American. The highest ranking civil service at the Department of Treasury resigned before he became complicit in turning over this information. So I know that Chairman Scott had to leave, but I want to underscore Senator Warner's point, and I know that Senator Warren shares these views, that this committee, which has partial jurisdiction over the Department of the Treasury, we should have an urgent hearing on this. This should be a top priority. I would hope all of our colleagues, regardless of party, would want to know what is happening to this incredibly sensitive information that's just been turned over to somebody who happened to contribute over $250 million to President Trump's reelection efforts. In my view, it's a corrupt bargain, and I think we should have a hearing urgently to address that matter. A lot of people ride banks, but Elon Musk goes after the Treasury Department. It's a big heist of personal information, and in my view, it's an abuse of power. I appreciate Senator, and by the way, a lot of the statements that have been made regarding the use of some of these federal funds, whether by AID or other foreign aid programs, have been patently false, made in some cases by the chief spokesperson over at the White House. Just been proven false, and they haven't been able to provide any information to substantiate those claims. I appreciate Senator Warren's pointing out that CFPB has been on the front lines of trying to protect people against debanking. So it is ironic that many people who want to make sure that we prevent debanking are trying to get rid of the CFPB. Mr. Klein, I appreciate your statements regarding the issue of overdraft fees and pointing out that for Americans who live paycheck to paycheck, and we're talking about tens and tens of millions of Americans, their lack of access to real-time payments is causing them to incur these huge additional fees. I think you said your estimate is $5 billion a year, and it's also, in some cases, resulting in getting them debanked. Is that correct?
Absolutely, Senator. One of the ways you get put on this do not bank list is that your account is closed. Say you withdraw your account in good standing and you close it, but then the bank says, oh, for that last month of your account, you didn't maintain a minimum amount, so you owe $10. And they send the $10 to your old address, but you closed your bank because you moved and you never got the mail. Well, that $10 fee then becomes another $10 a month, another $10, and they write it off into collections, and your data gets put on this do not bank list because your bank account was closed in bad standing. And that's exactly how that process works.
So you referenced legislation that Senator Warren and I have introduced, the Payments Modernization Act. Could you talk about how that would address this very real problem?
Absolutely. The Expedited Funds Availability Act of 1987 requires the Federal Reserve to make payments move faster as technology allows. The Fed has done nothing in 37 years to update that regulation. As a result, banks sit on your money. We can all agree in this committee and every American that Friday was January 31st. If you were short on your rent, on your other obligations, you worked a second job, you got paid that Friday, and you deposited your check, you took a picture of your check. I was on this committee when we passed a Check 21 Act that lets you deposit your check on your phone on Friday. The bank can sit on your money, and it just became available yesterday. What happened between the 31st and the 4th? A bunch of bills got paid. The result of that, overdraft, overdraft, overdraft. Now, your legislation would force the Fed's hand, even though the law says shall, not may, but shall. The Fed just ignores it. Your legislation would rewrite that law to mean that your money would have been available on the 1st when your debits came out and your overdrafts wouldn't have hit, and it would save people a tremendous amount of money. The Bank of England did this in 2008. If we did it then, $100 billion a year would have gone back to people from check cashers, payday lenders, and overdraft fees. It's the best thing you could do to reduce income inequality without raising taxes or increasing government spending. And I can't understand how Amazon can get anything to your door faster than two banks can clear a check.
Thank you. Thank you.
Thank you, Mr. Chairman. I would like to welcome some Alabamians that are in the audience, in particular Laura Kate Robertson, who is a senior in high school and is an outstanding star, and certainly proud to have her here today. Also just want to say thank you for holding this hearing, Mr. Chairman. It's clear, and it's been no secret, that our financial regulators have become increasingly politicized over the last 4 years. We have heard our ranking member talk about the number of complaints that have been made to the CFPB over the last 3 years, and yet this committee, in the last 2 years, led by obviously one of our Democratic counterparts, has not held a hearing diving into this. So thank you, because this must stop. This is the United States of America, and what's happening is completely and totally unacceptable. Look, when you're prioritizing a social agenda or a political one instead of actually ensuring that people have an opportunity and access to the American dream, we've got to call that for what it is. And obviously our large institutions play a vital role in our country and our banking system, but they need to stick to that banking, not politics. And so, Mr. Ring, what you've testified here to today is incredibly alarming, and we need to get to the bottom of that. I also just want to point out something that my colleagues have to hear me say all of the time, and that is just how grateful I am for our community banks and credit unions in Alabama that serve our local communities and give people access to the American dream. And remember that that is actually what they're there for, so thank you to them. I do want to get to the bottom and better understand what spurred this debanking and why certain industries and conservative aligned groups have been targeted over others, and importantly, how we can prevent this moving forward. So I want to start by quickly clarifying a few things for the record. The first Trump administration finalized a fair access to banking rule focused specifically on addressing this issue. Mr. Gannon, what happened to that rule?
That rule was revoked on January 20th, 2021.
Tell me who revoked that.
The President of the United States.
That's the day he was sworn in.
That's correct.
And so the day he was sworn in, he said, we're not going to do this.
There were a number of rules that were revoked that day. That happened to be one of them.
Well, thank you, Mr. Gannon. Is the supervision of the reputational risk a directive from Congress or found anywhere in law?
Well, that's a little bit of a complex question. It certainly is found in law in the sense that Congress has directed the banking agencies to conduct supervisory activities, but the details about how that supervisory activity is conducted is almost entirely generated by the regulators themselves.
And you mentioned earlier the subjective nature of
Right.
that. Does the reputational risk have any real connection to the material safety and soundness of a bank?
Almost on no occasions that at least the literature has been able to come up with is there a connection between reputational risk and some of the basic elements of banking, capital, liquidity, operations, and so on. There's a disconnect there. And in fact, the regulators, and this is quite interesting, at least to me, the regulators have defined stakeholders for reputational risk, and one of those stakeholders is themselves. So it's a little bit difficult to argue with a regulator when they say you've got reputational risk.
Now, that's something.
Because you're arguing with the stakeholder that owns that reputational risk.
Tell me, you mentioned earlier in your testimony about management rating, and you
Correct.
said many times it has actually nothing to do with management. Can you dive into that a little bit more?
Well, I'll go back, Senator, what I just said. If you look at how banks really are resilient today, how they have higher levels of capital today, how they have more liquidity than ever, how they have invested, a very interesting statistic in 2016, which is a baseline that this data comes from, which was not an easy year for banks. Mr. Cirillo was still the kind of acting vice chair for supervision of the Fed. Banks spent, let's say, $100 on technology in terms of compliance. Mm-hmm. Last year, banks would have spent $160 for the same activity. So banks have poured money into technology, into compliance, et cetera. Now, are banks perfect? No. Do things slide through? Yes, they do. But I don't think anybody can doubt the commitment to invest in these sorts of things, and reputation risk doesn't have anything to do with that.
Thank you very much. And in my final few seconds, Mr. Ring, just to level set here, what are the real world impacts to a small legally operating business if they are denied access to our financial system? Because I know that you have seen that firsthand.
Well, if you can't make payments and if you can't bank, then you can't exist in America. And it's happened in crypto, it's happened in the Second Amendment space, it's happened among conservative causes. You can't exist without banking.
Thank you for what you're doing.
Thank you.
Thank you. I am sorry one of my colleagues had to leave, Senator Kennedy, because I do need to address this, and I so appreciate my colleague, Senator Warner, bringing this up. You know, we can and we should be identifying waste, fraud, and abuse. I think we all agree about that, and we can do it, and we should be doing it as a Congress, but we should be doing it without giving a private, unelected citizen access to the federal Treasury payment system that contains personal information of U.S. citizens. Now, I hear my colleagues all the time invoking former President Biden for all the bad things. If he had done this, I know my colleagues would be the first to call it out, and I would be with you. I would be with you. This is such an important issue for us to stand together on, and if we don't, who will? Who will? So I am frustrated along with my colleagues on this, but let me get back to the issue at hand, because I also want to address the overdraft piece, Mr. Klein. You know, a vast majority of people who complain to the CFPB, but also to AGs, I'm a former AG, I heard this as well, about losing access to bank accounts, usually blame overdraft as the reason. Right? And we know that one of the areas of focus and enforcement around this is, if not the Attorneys General, then it is the CFPB. And we know the CFPB took action to prevent illegal, punitive, expensive overdraft fees. In fact, in November, Navy Federal Credit Union agreed to refund more than $80 million to service members and their families. By the way, service members are the #1 group that is always constantly taken advantage of in this area. And the credit union also paid a $15 million civil penalty for charging illegal and deceptive overdraft fees. So, Mr. Klein, you've been leading the call to end abusive overdraft practices. We've heard you today. Can you talk a little bit more about it? And it's more than just somebody, just a bad check out there, right? I heard one of my colleagues, well, they're just right, bad checks and they should be held accountable. It's more than that. Can you talk a little bit about what we're talking here?
So it's about reordering your transactions. You swipe your debit card during the day and maybe you run out of money at the end of the day. Well, there are banks and credit unions who go and reorder your transactions from the highest dollar amount to the lowest in order to maximize the number of overdrafts that you have. The state of New York just put out some new regulation prohibiting that practice of reordering your account. There's other things about systems of debits and credits. Look, our outdated payment system runs on this technology called a batch, which, not to bore you, but think about your washing machine. You throw everything in, you hit a button, it all comes out clean at the same time. One of the big values of real-time payments is it goes piece by piece, laundry by laundry. When you do a batch, you don't know what comes out. Well, the question becomes, when the batch is clean, do we put in your credits first, or do we take out your debits? And which order you pick, debits or credits, makes a big difference in the total quantity of overdraft. If you post your credits before you put the money into your account, right? So that's another pernicious practice that we see. And this is how you see a bank like Armed Services generate $92 of overdraft per customer relative to other national banks that are around $1, $2, $5, $10. You say to yourself, how can Armed Services Bank get $92 of overdraft per customer? It's these types of tricks and trades. And you're right, Senator, that in my research, I keep finding that you find these practices at military bases, you find these practices at places that co-locate in Walmart or seek out other things. 9% of Americans pay 80% of the overdrafts. Those are very profitable customers for certain types of banks who try to bring them through the system. And the last point I want to make, as it relates, Senator Tillis made that comment about, oh, you passed a few bad checks. Why the check bounce? Well, the check bounced because of this time delay. Other banks that have given people 48 hours to cure an overdraft have seen their overdraft numbers fall by 50%. This is some of the types of reforms that would occur if you moved to a faster payment system and you eliminated some of these checks. And sadly, the prudential regulators over the last 4 years have done nothing to stop these banks and credit unions who rely on overdraft for more than 100% of their profit. They're given safe and sound CAMEL ratings. I don't understand how their management has such a high CAMEL ratings because all they're doing is overdrafting people. They should be a check casher, not a bank.
Thank you, Mr. Klein.
Thank you very much, Mr. Chairman. I want to thank Chairman Scott and Ranking Member Warren for holding this hearing, and thank you to our witnesses today, Mr. McCauley, Mr. Gannon, Mr. Ring, Mr. Klein, for being here as well to talk about this important topic. What we saw over the last few years, the Biden administration weaponized government at all different levels to be able to push its liberal agenda on the rest of the country. We saw it from things like having the EPA push EV mandates, Homeland Security ignored illegal immigration. We saw a number of different agencies do things. The FBI, for example, even identified Catholics as extremists and sought to put spies into the Catholic Church. All of this undermines people's faith and belief in our system of government. And what we're talking about here now, where we have regulators that are pushing their agenda, does the exact same thing. It undermines the rule of law in our country if regulators start pushing an agenda of what they want to see, what kind of businesses you do business with, versus what you're allowed to do, versus just saying, making sure we have a safe banking system that is complying with our rules and regulations. A legal business should not lose access to the banking system just because they deal in firearms or crypto or something like that, because a regulator doesn't like that. That's just simply wrong. But that's what we've seen, of course, out of the last two administrations. It was mentioned earlier about Choke Point 1.0 under the Obama administration, and firearms deals, for example, that were disfavored, were prejudiced against and tried to force out of the financial system. And I think it was you, Mr. Ring, just said that if you're out of the financial system, you cease to exist as a business. And then, of course, now more recently under the Biden administration, it's been the crypto industry. And I got to tell you, this is an issue that's near and dear to my heart. I came from the financial services industry. We have the most transparent, liquid capital markets in the world because of proper regulation. Regulation actually got us to the point where we have these great capital markets. And it's at risk when we have regulators that are undermining the faith in that. We've got to make sure that we do not weaponize our regulators to push an agenda. Mr. Gannon, during Operation Choke Point 1.2 and 1.0 and 2.0, did regulators exceed their statutory authority by focusing on vague metrics of reputational risk instead of safety and soundness?
Senator, the way I'd answer that is to say that the effect of Operation Choke Point 1.0 and 2.0 is that many small, perfectly legal businesses are no longer in operation. The people that ran those businesses lost their jobs, lost their bank accounts, not sure what they're doing today, but that was a backdoor way to make those businesses illegal. And getting to the point that I made earlier, if the regulators wanted those businesses to be illegal, they had to come to you and ask, and they didn't. Instead, they just executed their own agenda without the approval from Congress. And that's what I mean by a distortion of the relationship between regulators and Congress. Their power comes from you. It does not fall from the sky.
So did bank regulators evade the notice and comment rulemaking requirements of the Administrative Procedures Act by imposing requirements through informal guidance documents in both choke point operations?
Yes, they did, Senator.
And why do you think they were doing that?
Because notice and comment, and by the way, the Congressional Review Act, has the effect of shining a light on the activities that are afoot. You have to give notice. You have to take into account the comments critically. You have to do, if you're going to pass a rule under the Administrative Procedure Act, you have to do a valid cost-benefit analysis, and those sometimes can be difficult. Economists should run those. It's just simply hard. And oh, by the way, rules that never got approved through the Congressional Review Act process have never taken effect.
So in fact, to your point earlier, by issuing informal guidance, they were purposely trying not to come to Congress or not to raise the attention of the public of what they were trying to do. Is that a fair statement?
I can't get into their head, Senator, but that's the effect, for sure.
Mr. Ring, your bank was one of many that was issued a consent order by the FDIC in recent years. Is that correct?
Yes.
Would you describe your relationship with your regulator to have been collaborative or more combative?
I think it has gotten better recently. In fact, a great regulator at the FDIC, Joe Meade, who spent 30 years there, recently left, retired, invested in our bank, and he's now on the board. And I think that has helped. But they definitely do not make it easy to be a new and growing bank.
Right. Well, I see my time's up, Mr. Chairman, but I do want to just wrap up by saying, again, my experience in the financial services field was that when you had regulators that had a relationship with the regulated community, that actually helped them do their job, to find the bad actors, and we all have an interest in getting rid of the bad actors that are in our industries. And that when you take an approach where you weaponize government, it's actually bad for the regulatory scheme in general, because players, companies who are good, that are trying to stay in business and actually follow the rules, are discouraged because the regulators are acting in a political manner. So thank you for indulging me there.
Senator Kim.
Thank you. Thank you to the four of you for coming on out. Mr. Klein, I wanted to just start with you. I thought you made some very poignant assessments about the suspicious activity reports in particular. You mentioned about just, millions of these every year that are being used. But as far as I could tell from your testimony, it doesn't seem like there's any feedback, any sense of, are these useful? Is that correct?
Correct. Banks are not judged on the quality of their performance, they're judged on the quantity. And the consequence is the bank has every incentive to file more without getting information as to the quality of it. This is how filings have increased tenfold in 20 years. In my written testimony, I cite some work that shows that the ability of it to lead to prosecutions for tax evasion, one of the primary purposes of AML, has been extremely thin.
And so we're seeing this situation where the banks are filing millions of these, costing them a lot of money and time, but we're not certain whether or not it doesn't sound like they're getting any real feedback in terms of whether or not those have been useful. And I think you cited, in fact, in terms of some reports, it seemed like the IRS prosecutors maybe used only a few hundred of some out of millions of different reports that come before them. Is that correct?
It's correct. 327 reports started a prosecution on tax evasion out of about 27 million. That's a piece from Nick Anthony at Cato. And let me just say, the way that I've come to analogize this is the thesis of the entire AML process is like a criminal is like a scuba diver swimming deep in the dark ocean in order to evade detection. And the money from the criminal activities are like the bubbles that float to the air. And the idea here is that you use the data that comes in SARS and other things to find the bubbles and go down. But in point of fact, all we're doing in the current process is blowing air into the system. I don't understand who's reading all of these SAR reports. And this gets to the point about state licensed cannabis that was raised earlier. That's federally illegal. If the DEA wants to go in and shut down any cannabis company in a state, they can. But you don't need a bank report to tell you.
Argument in terms of the currency transaction reporting, in terms of the lifting of that number that hasn't been lifted in quite some time. But I guess I want to ask more specificity when it came to the suspicious activity reports. Do you have more concrete reform proposals there that our committee should be looking into as we're thinking about our next steps?
Yeah, no, absolutely. So for example, on state licensed cannabis, right? If you're running a state licensed cannabis business, you should be treated like other businesses. If law enforcement wants to deal with you, go to the state capitol, find where you are. Why you're being treated differently makes absolutely no sense. The second thing is, let's be clear on what the priorities are for banks to file SARs. There are areas where I think more suspicious activity like elder abuse, which has been the subject of another CFPB report, is one where you could be providing more information. But there's a whole host of different categories of activities. And I think what we need is a whole blue sky approach where Treasury's Financial Crimes Enforcement Network and the bank regulators are brought before this committee and the public to discuss a prioritization of what we're going after. Because in the 50 years we've been doing this regime, we keep adding more targets, never taking anybody off the list.
No, I think that's right. And, I have to say, Mr. McCauley, when I was, hearing your testimony and just, I'm sorry for what you went through in that kind of capacity. And when we look at the reputational harm or reputational risk that banks are considering here, yes, it certainly seems like this excessive amount of reporting, other things like that are adding to it. And I think one thing I hope we can all agree on is, having greater sense of transparency across the board, but then also some sort of feedback loop, some process by which to try to appeal, because it's not just on the SARs, but, also the customers are unaware that something has been filed about them, and so there's just multiple layers of lack of transparency on that front. And also just I want to just raise this, not ask a question, but Mr. Klein, also you showed how with CheckX, for instance, and other components, again, that sense of transparency is missing, as well as that lack of ability to appeal. So it just seems like that's something systematic that I think this committee can hopefully dive in deeper on. So thank you so much, and I yield back.
Senator Banks.
Thank you, Mr. Chairman. Economy, Indiana is a small town. Mr. McCauley, congratulations on your success.
Thank you.
It's really incredible, fellow Hoosier, to go on and do the incredible things that you're doing. My question for you is, obviously, what happened to you was wrong. It was disruptive. It didn't just affect you, but it affected a lot of your employees and your partners. Was there ever an opportunity for you to seek or recover any of the losses that occurred to you?
Senator, there wasn't any opportunity to recover. The way losing your bank account works is you spend a lot of time, you spend a lot of efforts, but there's not some sort of a recouping you can do there. We did appeal to our regulator, the OCC, and let them know that this was happening to us, that our bank accounts were being closed and that we're having some disruption of services there. But unfortunately, they weren't able to necessarily help. They can't necessarily say positive or negative things about any particular bank, and so they weren't able to help us get banked anywhere else.
Can you quantify the loss to you and others involved?
So we had a trading business that we were operating that was doing hundreds of millions in volume per month that went to zero because we were no longer able to bring on our clients' cash and bring that into our institution. Because of that, we had to part ways with some of our staff, as I mentioned in my written testimony.
And I assume that it wasn't just really rich people who were affected by that. Common, everyday, working class investors that were affected too.
Senator, our bank serves institutional investors, many of which are creating the products that the retail investors of America use. For example, ETFs. We custody for some of the ETFs that are now owned by a broad swath of the U.S. population.
Okay. Let me ask this a different way. When an innovator gets hurt, it always benefits the incumbent player in the industry. Do you think that the big bank that debanked you had incentives to do that?
Senator, I actually don't think that they did that. I think that many of the large banks in the country were actually in active conversations with Anchorage to add crypto as an offering. So they were looking to maybe become crypto custodians themselves or expand into that business line, which makes it so clear that this was not something that they wanted to do. They did not want to debank crypto. Rather, they wanted to embrace crypto, but they were very suddenly forced to take a 180 direction and go in the opposite direction, not just stopping some of their crypto activity that they were looking to expand into, but actually closing accounts.
The Biden administration often claimed that the crypto industry was a magnet for fraud and crime. But you testified that Anchorage met the same know your customer and anti-money laundering standards that every other bank does. Why do you think the Biden administration was so dead set on suffocating cryptocurrency?
Senator, I can't necessarily comment on the motivations. What I can say is that if you look at the way that the BSA works within America, the BSA works in America via the banks. The banks are the ones that carry that out. So the very idea of kicking crypto out of the banking system was self-defeating, because the way that we get transparency, the way that we get monitoring of an industry is to have it be integrated with the banking system. And so that's why I think the debanking was so wrong-headed and did not make any sense.
Mr. Gannon, when I think of debanking, I think of all of my services from the bank being taken away from me, but is there something in between? I mean, in banks that might put holds on transactions or investments that we might not think of as debanking, but would also be a similar type of politically motivated activity?
Senator, that's possible. The technology exists to do it, but it's usually more broad-based than that. Just as an example, I happen to be aware of a vineyard where the wife of the vineyard owner happened to be an investor in the cannabis industry. The vineyard and the individuals that own the vineyard all lost their accounts. They had nothing to do with the cannabis industry, but I guess it was a knock-on effect as far as the regulators were concerned, because all those accounts went away. That's the kind of, unfortunately, it would be nice to think that the regulators work with a scalpel, but it's really usually a 5-pound sledgehammer and a chisel.
Very interesting. Thank you. I yield back.
Thank you. Senator Warnock.
Thank you so very much, Mr. Chairman. Before I begin my questioning, I want to reiterate the requests Ranking Member Warren and my Democratic colleagues have made to the chairman to hold an oversight hearing in this committee on Elon Musk's dangerous access to the Treasury Department's systems that control $6 trillion in annual payments to millions of American citizens, including Social Security, Medicare, and tax refunds. I can tell you that the people of Georgia are not taking any comfort in the notion that this unelected billionaire has access to these systems. I think it's urgent that this committee and the Senate Finance Committee have a hearing to look into this matter to protect Americans' private data that they are required to provide and is now in the hands of Elon Musk and 22-year-old interns. We are approaching the 2-year anniversary of the failures of Silicon Valley Bank, Signature Bank, and First Republic Bank, 3 of the largest bank failures in U.S. history. A review of Signature Bank's failures found that the FDIC, the federal bank regulator responsible for making sure our money in the banks is safe, did not properly staff the team dedicated to the bank with regulatory job vacancies averaging 40% in the years leading up to the failure. Bank examiners are overstretched and overworked, and based on today's conversation, it is clear that banks are begging for more communication, more certainty, more clarity from understaffed bank regulators. The last thing you want in business is uncertainty, a lack of clarity. This is why I was frankly shocked by the FDIC's decision to withdraw job offers from more than 200 new bank examiners last week. Mr. Klein, you're an expert in bank regulation. Do you agree FDIC bank examiners are understaffed?
Yes.
And do you agree that this understaffing has consequences for bank examiners' ability to communicate with banks to provide regulatory clarity, especially when banks are dealing with newer businesses that offer complicated or potentially risky financial products or services?
Absolutely.
What I'm hearing is the Trump administration's decision to rescind job offers to bank examiners at the FDIC is going to make it less likely that some businesses, including the ones that my colleagues here today are concerned about, can access the traditional banking system, or that they will be well served by it. Is that fair?
Yes, one of my colleagues just talked about the difference between doing things with a scalpel and a 5-pound sledgehammer, and this hiring freeze is a really big sledgehammer.
I agree with that, and not only did the Trump administration rescind bank examiner job offers, they also emailed current examiners and basically encouraged them to quit, which will only compound our staffing problems for all of these businesses. Mr. Klein, in addition to harming access to the banking system, what other risks may arise from understaffing our bank regulators?
Well, I mean, people talk about the need to create new banks. New banks have to be approved. It's a charter, not a license. And you need people there to approve the charter. You need people to update your models. You need people to collect and promote data and information. And there's a whole host of things that could be slowed down by simply being unstaffed. In addition, the FDIC is a little bit like an ambulance. It comes in when a bank fails. We've had several bank failures this year already. And you need to have an emergency SWAT team who's ready to go in. The FDIC does a fantastic job of handling a failed bank. It closes Friday evening. Monday morning, insured depositors have full access to their money. That requires people, and it requires trained people, expert people, people with experience. Sometimes these things are more complicated, particularly in small-town America, where you can't just show up 30 people and sit in a hotel and not raise some concerns. And understaffing this puts our ability to handle failures so that people have access to their money immediately at great risk.
So I think this is very important because there's always this sort of baked-in assumption that having regulators is a drag on the business, but you're demonstrating through your testimony that understaffing these bank examiners is bad for business, bad for innovation. And everyone agrees that legal businesses should not be systematically excluded from the financial system. However, the way to do that is to hire and to empower regulators who can ensure banks are safe and sound and provide clear guidance to banks on permissible levels of risk. Revoking job offers for bank examiners and pushing these experts out of their jobs in the precipitous way that we've seen, especially over the last 2 weeks, puts all of us who rely on banks to keep our money safe at risk, and it's a drag on the business. This is an issue that I look forward to continuing to work with this committee on. Thank you so very much for your testimony.
Thank you, Senator Warnock. Senator Kramer, thank you for letting me, well, you just stepped out. Thank you for letting me take your spot. Over the past 4 years, I've seen a shocking number of industries and individuals be denied financial services here in America. I recently spoke with a company in my home state that is in an industry that's often politicized but always lawful. Here's what's happened to them. They've been denied business due to, quote, reputational risk. They've been prevented from expanding their credit facility. They've been denied insurance policies, and they've been denied the ability to renew coverage. These are shocking problems that we see here, and this entire constellation of problems exists at multiple levels. First, you've got partisan ideologues that actually operate within banks, public affairs divisions, or their so-called reputational risk committees that are exerting their influence to choke off disfavored industries. You've got externally banks being pressured by political activist groups. You've got these shareholder proposals that are coming at the behest of a number of outside players, and particularly enabled by proxy advisory firms, which is another issue that this committee will get at. And lastly, we've had activist regulators that have abused their supervisory authority. They've imposed their own policy agendas that were never authorized by actual banking statutes or by the Congress. Bank examiners' subjective assessments of risk are ripe for abuse by ideologically motivated supervisors. The banks themselves are unable to speak out about debanking because when regulators pressure them to do it, there are strict confidentiality agreements, there are requirements, I should say, that prohibit these banks from even mentioning the reasons for service denial. Clearly, the banks themselves are very concerned about regulatory retaliation. So whether this de facto debanking stems from either within the banks or within regulatory agencies, in both cases, we have unelected individuals that are dictating what kind of companies can exist and thrive in our nation, and with no directive at all from the American people or from their elected representatives. So, Mr. McCauley, I'd like to start with you. This morning, FDIC Acting Chairman Travis Hill released 175 documents relating to its supervision of banks who are attempting to engage in crypto-related activities. These documents confirm that banks faced extraordinary resistance and actually directives from supervisors to pause, to suspend, to refrain from expanding all types of crypto or blockchain-related activity. Mr. McCauley, have you seen us lose American companies and innovators to other jurisdictions as a result of the hostile posture of our federal government?
Senator Haggerty, thank you for the question. I actually printed out one of the documents that came from the FDIC drop this morning. It's right there in plain letters. Quoting, "We respectfully ask that you pause all crypto asset related activity." This is not suggestion. This is right to the heart of it. The FDIC was asking banks to pause their activity with crypto. The net effect of that, like you said, has been that a lot of the crypto activity has moved to other jurisdictions where people feel like they'll get a fair shake, like they will get a fair opportunity to actually build their business. This has been damaging. Many of these kinds of businesses are businesses that we want within the United States. Crypto businesses, crypto exchanges, and notably stablecoins. So I thank you for your introduction of the bill about stablecoins. I think charting a path forward here is very important to us, and thank you for your leadership.
Well, I think it's incredibly important, and this type of innovation that we'd like to see on American shores is being pushed offshore. Can you tell me who signed that memo that you're looking at right now?
This one is signed Eric T. Guyot, I think. He's the Assistant Regional Director.
Well, whoever this person is, I've never heard their name before. They certainly aren't an elected official. Yet, this person is taking on the authority and the responsibility to debank an industry here that has tremendous potential. So I think it's deeply concerning. Mr. Gannon, I want to turn to you very quickly. There are important parts of our BSA and AML regime that are susceptible to weaponization for political purposes. Under our current system, senior public officials and their families can be designated as politically exposed persons, or PEPs. And once you're designated as a PEP, you think about it. Former Senator Sam Brownback was designated a PEP. It results in higher regulatory scrutiny and therefore an increased chance of account closure. In your view, Mr. Gannon, how can our BSA and AML regime most effectively balance what are legitimate law enforcement concerns with the risks that unwarranted account closures are going to occur, with the effect, the actual dampening effect, the chilling effect that we've seen taking place? How do we balance that?
Senator, there are two things I think that can be done. Number one is I think the partnership between the banks and the regulators needs to get into the 21st century, and there's much better technology that exists rather than sending armies of people to go around filling out SARs and filling out currency transaction reports. If you have better data, you will have better results. And if you have that result, that better result, then you can determine, is somebody being debanked because, in fact, they're a risk, or are they being debanked because they may have some sort of association that the regulators find unpleasant?
Thank you. Senator Gallego.
Thank you so much, Chairman and Ranking Member. Mr. McCauley, in your testimony, you explained how Anchorage Digital Bank manages risk and identifies suspicious activity to comply with regulations. So how often would you say you detect potentially suspicious activity among your bank's clients?
Senator, we have active monitoring programs that look for suspicious activity. One of the things we're actually most proud about our systems is that we think they go beyond what traditional banks are able to do, in that we look not just at point-to-point transactions, which are available in traditional banking, but because of the rich data that's available through blockchain systems, we're able to detect far more of that. Now, our client base that we serve is primarily institutional investors, so this is not the place that's necessarily set up to have a lot of potential money launderers in there, but we do make sure that any suspicious activity that we do detect is detected and
And you go through the proper protocol filing when you see something, everything else like that, to abide by the regulations so it doesn't come down on you or your shareholders. Did you ever, because of just kind of a potential risk or feeling of risk, within your own discretion, or maybe just felt like it's just not worth the hassle, choose to not open up a client or decline a client of any sort?
Absolutely, Senator. There are use cases that our bank is not well set up to support. There are client types or types of client activity that are not appropriate yet for the systems that we have in place. And so we do express some amount of judgment on that, on whether or not we can properly take on an account and handle the risks that may or may not be present.
Or just the hassle that may come with it, because then you have to communicate with the government and have to go back and forth for something that may not have much of a marginal return on investment.
Yes, I think this is a standard banking procedure.
Yeah. So it's important that we all think about this aspect of the problem, because every bank and different regulators have different risk tolerances, and I think that's a very healthy thing for us to understand. But we should be very wary of kind of overcorrecting also on the other end. That could also increase risk to the banking system. And I think you're a good example of how to do it correctly, but others may not. Mr. Ring, in your testimony, you quote, had to deal with duplicative and overly burdensome regulatory redundant, sorry about that, during the process for Old Glory Bank. What specific processes were duplicative, and how would you propose we consider addressing these problems while still making sure our regulators preserve their risk-based approach to monitoring safety and soundness in the banking system?
Oh, that's a great question. Thank you. So to put this in perspective, we bought a $10 million bank with only $3 million of loans in Elmore City. That's probably smaller than some bank accounts in here. And it took...
Not me, I wish, to be honest.
It took 6 months, 3 rounds of additional information requests, and 300 pages of submission, and then an all-hands call. And we had to deal with the FDIC, the Federal Reserve, and then even on the all-hands call, we had the CFPB there. And respectfully, I have never talked to a regulator that was actually a banker, in all respect. Like, if you deal with the FAA, they're former pilots. If you deal with so many organizations, they're actually the former business people. I've only dealt with the federal regulators who, respectfully, were bureaucrats, and these are people who have never signed the front side of a check, and I feel like they do not have the ability to apply judgment to some of these rules.
Well, what specifically would you recommend then?
I would, going forward, make sure that you hire at least half of all regulators with prior banking experience, who actually know the impact of their regulations.
And any other?
I would go back and find the last chairman of either the FDIC or the OCC that actually was a banker. I really think it's about that. And then, respectfully, I think they need to quit stepping over dollars to pick up pennies. If you think about the banks that failed in 2023, it was lack of liquidity, and yet they're focused on the minutia of...
It was bailed out. It's the single largest depositor at Silicon Valley Bank was a crypto stablecoin company. Silicon Valley Bank was a crypto stablecoin company that had $3 billion. And as an economist, I can't dream of a better natural experiment to understand the solvency of this stablecoin than the fact that on Friday afternoon, that Silicon Valley Bank was being closed under normal operations, which would have incurred losses on uninsured depositors. And that stablecoin went from $1 to 87 cents on Saturday as people started to run. Then Sunday, the regulators bailed out, took all of our money, taxpayer money, fees banks are going to charge back on overdrafts and other low-income people, and bailed out $3 billion back to that crypto, and its stablecoin went right back up to par. And so what you see in this situation is there is a connection in crypto in the banking system. What you see in this situation is that banks fail, and Silicon Valley Bank failed for a variety of reasons, but primarily because of its strategy, right? And I do agree with Mr. Ring on some of these concerns about the relationship between banks and their regulators. The CEO of Silicon Valley Bank sat on the board of the San Francisco Fed.
Thank you so much. We're heading over to Senator Moreno.
Well, thank you, Chairman, for the time for the hearing. I think it's very timely. I think one of the things I'd like to say at the beginning, especially for people watching this, is that this can be a very clinical conversation. We're talking about debanking, but the reality is you have entrepreneurs that are absolutely getting devastated by these policies. I think it's hard for some of my colleagues who've only been maybe attorneys or career politicians to know what it feels like as an entrepreneur to chase a dream and have that dream completely crushed, not because you had a bad idea, but because you had a government that was looking out for itself and not looking out for you. So let me just say that from the beginning. Let me start with you, Mr. McCauley. What type of cryptocurrency did Al Capone use?
I would say that primarily the privacy coin known as the US dollar.
Gotcha. Okay, so I'll look that one up, see if we can ban that one. How about Pablo Escobar, my fellow Colombian who gave a lot of reputational risk to fellow Colombians in what he did? What kind of crypto did he use?
I don't think he used any crypto.
Gotcha. How about Meyer Lansky?
I'm not sure.
There were some comments about dictators in North Korea being empowered by crypto. How about Ferdinand Marcos? What was his cryptocurrency of choice?
He did not have one.
Joe Kennedy?
Did not have one.
Okay, gotcha. So maybe money laundering wasn't invented by digital currencies. Would that be fair to say?
Very fair to say.
Okay. Let's move on to this topic of, Mr. Gannon, by the way, your bank helped me start my business. Let me just give that little disclaimer up front. I appreciate your former
happy
chairman.
And proud to know that, Senator.
Mr. Fish was very helpful, so let me just get that conflict out. I've subsequently sold all my businesses, so I have no conflicts. But let me just say this. How much of loans do you just automatically forgive? Like, I was a really good client. Made payments. When could I call you and ask you to forgive my loan?
I don't believe you could do that, Senator.
Gotcha. So I'm curious, because there was a conversation from one of my fellow senators earlier about the rogueness of the Trump administration, and yet Joe Biden illegally, according to the Supreme Court, forgave student loans. And I don't remember that outcry, that need for an immediate Senate hearing on why we were not forgiving, not chasing, why we'd forgive student loans. Now, maybe my Democrat colleagues think it's great that somebody becomes a gender studies major at Brown and racks up $200,000 student debt, but I had technicians working for me that racked up thousands of dollars in tool loans that the bank wasn't really. So what's wrong with a technician that a gender studies major should get their loans forgiven, and why aren't we seeing outrage on that? Mr. Gannon, have you ever heard of such a thing as loan forgiveness from banks? And please give me the name of that bank.
I don't have a name for you, Senator, but what I can say is some of my best friends at the banks where I've worked were credit risk analysis, and they look very hard at each loan, and they analyze the credit, and if we make the loan, we expect you to repay it.
Oh, that seems like an impossible standard. So let's move on, Mr. Ring, to you on this topic of regulation. It seems like there's a debate in this room of who's caused debanking. The good news is we've agreed that there's debanking. I think that should be the first headline. The most
Not so long
bipartisan
ago,
thing.
people were denying.
Right, so we've agreed on that. That's an incredible accomplishment of the 119th Congress. We've reached that conclusion. So the question becomes, why and who's responsible. Now, in your mind, do you think that is it easy for a small community bank, let's say, for example, in Montpelier, Ohio, to compete with JP Morgan Chase or Bank of America?
It's almost impossible. I find that about 75% of our time is spent serving regulators and only 25% serving customers. And when you're on small margins of a community bank, you cannot compete with the big guys easily. Now, we're working hard at it, but it is very hard. Because we have the same regulations as a big bank, but yet we have less people and less money.
So you don't have 2,000 lawyers at your beck and call?
Unfortunately, I'm both the lawyer and the CEO along with my wife. So we
probably HR also.
She is, and marketing.
All right, there you go. And Mr. Ring, I actually applaud your testimony around helping working class Americans that are getting crushed by banks. I think it's fair to say a lot of people know somebody or have themselves been screwed by banks. I think that's fair to say, and I appreciate that you're doing that. But I think it's competition that ultimately makes that go away. Don't you think, like, if there's just a lot more banks, a lot more choices, don't you think that's the best elixir?
So America has almost 10,000 banks and credit unions. I think that there are some serious structural problems.
How many did we have 10 years ago?
We had more, Senator.
How many did we have 20 years ago?
We had a lot more because you couldn't bank in multiple states.
So competition's dropped
If you want more banks,
so competition's dropped dramatically. So let me just end with this, and I hope my colleagues understand philosophically as a business guy, the most greedy organization on the planet is the government. You pay your taxes, Mr. Klein, 1 day late. What do you get paid? What do you pay, like a $5 overdraft fee? No. You get late charges, interest that would make the mafia jealous. So let's just understand that the reason the government is so damn greedy is because there's no competition in government. We need more competition in banking. That will fix this. Thank you, sir. Senator Brooks.
Thank you. First of all, thank you to Chair Scott and Ranking Member Warren for hosting today's hearing, and I want to thank all of our witnesses as well for your participation. I can say I agree with all of the others you've heard today who believe that we should both be expanding access to credit and capital for all Americans, and that we're concerned about making sure that we keep our financial system safe as well from criminals and fraudsters and scammers. And I happen to believe that we can do both at the same time. And so I also like like to say that that Mr. Cawley, Mr. Ring, you've both spoken about the need to protect the integrity of our financial system from politics, and I have to tell you that I could not agree more. And so these should be fairly easy questions that I have just for both of you. You both run businesses that depend on maintaining the trust of your clients. And so my question is, would these clients trust you if you share their most sensitive financial information with someone outside your bank and without their consent?
Senator, no, they would not trust us if we shared that information.
No, Senator.
And so I ask as well, so should an unelected billionaire be snooping on Social Security payments, say, for example, to my elderly parents? Would you agree that that was wrong?
Well, if you're talking about Elon Musk, I believe the unintended consequences of that is probably offset by trying to save taxpayers' money, and we haven't found a better way to do it yet.
And so you believe that your clients and other elderly people who find that someone's snooping around on their Social Security payments, that they would be okay with that?
I don't know Elon Musk, but I don't think that's what they're doing. I think they're looking at actual taxpayer monies going out the door.
Senator, if we hired an external auditor to come and look at our books to make sure that we were doing a good job of being fiscally responsible, I think our clients would welcome that.
And you think they'd be comfortable with doing that, someone doing that who is outside of your bank structure? Say, for example, could I do that and look at your client's information?
Senator, going through the right process and procedures for hiring and bringing that auditor in would be extremely important, and making sure they had direct, careful access to the data would be important.
So I just say I'd echo Senator Warren and Senator Van Hollen's sentiments on the seriousness of this, and I really hope that our business leaders will have the courage to speak out about a practice that I can tell you I know you would never allow for your own clients. And so my next question is for Mr. Gannon and for Mr. Klein. There have already been studies on how banks and bank regulators can better balance the need for safety and soundness with financial inclusion. So, for example, a 2023 report from the Treasury Department examined circumstances where financial institutions indiscriminately end relationships with broad categories of people in the name of mitigating risk. That report demonstrated that unfair debanking also often results in less financial inclusion, less fairness, and ultimately consumers and small business owners being pushed toward less safe and less affordable financial products and services. And that 2023 report recommended that financial regulators promulgate rules that promote a supervisory culture that balances legitimate risk, mitigation, and strategies that include financial inclusion. So, Mr. Klein, as far as you are aware, have regulators adopted this 2023 recommendation?
No, they have not. Regulators push banks to use systems like CheckX and other do not banks lists for BSA, AML, for other things, for other types of risk platforms, and they do not adopt this. And I've been extremely disappointed at what the prudential regulators have done. This Bank On movement has done a much better job, in my opinion, of trying to get a better screen to let folks in, folks who are not fraud risks. I'm unaware of anything in the Bank On program that has a greater risk of fraud than any other type of account. And so I've been, from my experience, I've seen too little adoption of alternative ways to bring people into the system, and too slow adoption by regulators to do something different.
Thank you. And just one final question. The Community Reinvestment Act is a law that encourages banks to meet the credit needs of underbanked communities, especially low and moderate income neighborhoods. And this law requires banking agencies to assess banking institutions' records of meeting the credit needs of its community. So I just want to ask quickly, Mr. Klein, how can supervisory debanking make it harder for banks to meet their community reinvestment obligations?
So I struggle because a lot of these overdraft predator banks I've seen have gotten outstanding Community Reinvestment Act from their regulators, who keep giving them a passing grade, even when the bank loses money on every element of its business model other than overdraft. So I've seen some deeply problematic practices.
Thank you so much.
Thank you, ma'am. We'll turn to Senator Kramer.
Thank you, Mr. Chairman, for having this important hearing. Ranking Member Warren as well for your leadership, and congratulations to both of you. The title looks good on both of you. Thank you. And thank you to our witnesses. I have to just state this hair on fire outrage by our Democratic friends over a successful businessman giving his time away from his business, I might add, to look at the books of the federal government to identify waste, fraud, abuse, and inefficiencies is some sort of a crime, while Mr. Ring's bank has never met a regulator that has a business background or a banking background. The irony is really quite rich. I think we should have a few more business people looking at our federal books. That said, thank you all for being here. My main interest in the debanking discussion, and I'm interested in all of it, and I think both sides have brought up a lot of interesting issues, but it's not so much the individual that I'm interested in, or even the individual company, but rather the categorical discrimination against large swaths of businesses, entire industries of businesses, constitutionally protected industries, legal industries. I find frightening, and I just want to reconcile, at least in my own mind, the different answers that the three of you gave to Senator Kennedy about which came first. Is this a problem with the regulators, or is this a problem with the bank presidents? To which I'd say yes. The precursor to the regulators, quite honestly, and the regulations, the precursor to this whole debanking thing was this bizarro ESG movement in corporate America. And that was happening before the regulators thought, hot dog, we got another issue we can, shove at these guys. So whether it's, I've talked to many of the bank presidents who very much support the legislation that me and 40 of my closest friends so far have introduced, the Fair Access to Banking Act, which doesn't require, by the way, a bank to do anything, but it does prohibit them from categorically discriminating against legal industries. And the reason some of the bank presidents who have never dared say it out loud tell me they support it is because they want this burden removed from them. They want this political pressure from their 30-year-old staff or the regulator, that they fear, or the political movement of the day, or the activist investors that are trying to impose their values. They want that removed from them. I'm just saying, let's not discriminate against large industry. And so, I guess I would just ask each of you, what's your sense of a bill like a Fair Access to Banking Act that, again, doesn't require anybody, it's not saying you have to bank this industry. It says you're prohibited from discriminating against this industry. Does this seem like a radical idea?
Well, if I could go first.
Sure.
I think the regulators have pushed debanking of industries, which you're talking about. I think mid-level executives push debanking of individuals for political causes.
Sure.
And my worry is, Senator, with a good intention bill like that, you'd have to prove somehow that we followed the law. And so every time a relationship didn't work out, there would have to be some type of reporting. And so I actually respectfully think the free market is always the best way to solve these problems. And with more banks, let banks bank who they want. If a pro-life bank wants to exist and not bank Planned Parenthood, let them, because there's a bank that would love to bank Planned Parenthood.
Well, if you're going to discriminate against large industries, should you be able to be insured by the federal government?
Well, that's a great question, because what's unfortunate is the regulators were doing this through policies and guidelines, as we've already talked about. Like, digest those, FIL 1622 and SAB 121, and that is how you stop it, is holding those individual regulators accountable, I feel.
Mr. Gannon.
Yeah, Senator, if I could respond to that by simply saying that what needs to be done, consistent with the act that you have introduced, is simply that there's more transparency.
Yes.
And there's more notice.
Yes.
When these kinds of decisions are made. And there's been a long sort of volume of executive orders coming out of the White House, but one of them revived an executive order from 2019 called 13892.
Mm-hmm.
That executive order gives more due process to folks who wish to contest the actions of regulators than the due process clause itself allows.
Well, maybe a law that puts that in statute would be better.
Correct.
My time's up, Mr. Chairman.
Thank you, Senator Kramer.
Thank you both.
Senator Lummis?
Thank you, Mr. Chairman. Thank you, Ranking Member. And I think that today was the first time I've ever heard the term hot dog used in testimony, and I so appreciate that from my colleague from North Dakota. Mr. Gannon, it's a pleasure to see you here today. I want to thank you for everything you've done for the state of Wyoming in the last few years. I just want you to know I'm personally grateful. And I'm going to start with you. In your legal opinion, what is reputational risk?
That would be very difficult to define, Senator, because it really has no definition. It's something that, as I said earlier, it's malleable. It can be reinterpreted. It's in the discretion of the regulators. So what is reputation risk today might be something different tomorrow.
Does it give bank examiners license to censor viewpoints or base regulatory decisions on someone's subjective viewpoint of what is a controversial comment?
It can.
Well, let me show you that it does. So here's this quote from an internal excerpt. It's a confidential Federal Reserve implementation handbook on account access. It requires that Federal Reserve staff consider whether a person has made a, quote, controversial comment in making decisions about access to the payment system. And of course, access to the payment system is a defining feature of a bank, is it not?
Correct. Very much so. Without that, a bank is a vault.
So is it dangerous for the Fed to serve as judge and jury on a particular banker's speech?
Senator, I'm kind of absorbing that still a little bit because it's really quite unusual. I've never seen anything like that before, but my immediate reaction is, number one, it sort of proves out the comments I've been making about the subjectivity around reputation risk, because who's to say what is controversial and what is not controversial? That's number one. Number two, it's chilling to me that it's possible that access to the Federal Reserve payment system might be dependent on whether the applicant was engaged in some sort of controversial commentary or now I can see it, or activities. That's the kind of stuff that is, that's the kind of thing you see in countries that appear on OFAC lists. So I don't see how it has any place in assessing the capabilities of an institution to have access to the federal banking system. We don't want to be in a place where free speech is chilled because there's a concern that I might not get access to banking services.
I agree very much, Senator, and I've been very deeply concerned by the Kansas City Federal Reserve's precluding places like the credit union in Colorado from accessing the payment system, and that chart puts my hair on fire.
If I might add to that, by the way, I believe in litigation involving an institution in Wyoming, Custodia Bank. I believe, if I recall correctly from the oral argument, the position of the Federal Reserve is that the Federal Reserve Bank of Kansas City has complete and unfettered discretion as to whether or not they allow access to the payment systems.
Well,
that's a lot of power.
Yeah, thank you, Mr. Gannon, and that is a concern of mine. I know this is hard to see. I couldn't see it from where you're sitting.
I can see it now.
Okay, let me read it to you all. This, again, is an internal memo within the Fed. It says, Reserve Bank staff generally should consider the conduct of the institution and its leadership and whether association with the institution poses undue reputational risk to the Reserve Bank. Is the institution's leadership associated with controversial commentary or activities? What is a controversial comment or activity? What is that?
Senator, I have no idea.
Is it in the eye of the beholder?
It's completely in the eye of the beholder, yes.
Mr. Ring, what is a controversial commentary or activity?
Well, considering things I've said about pro-America causes and the flag, I feel like that was written for me.
Mr. McCauley?
It appears to be a tacit attempt to hold back speech that is considered undesirable.
And thank you. What I would call this is hard proof of Operation Choke Point, and it's now been discovered by Congress. Thank you, Mr. Chairman. I yield back.
Thank you, Senator, very much for your thoughts and your comments. Thank you to each of the witnesses for participating in today's really important hearing. More to come, by the way. This will not be the last time we have an opportunity to talk about debanking in this nation. For senators who wish to submit questions for the hearing record, those questions are due 1 week from today, Wednesday, February 12th. Witnesses have 45 days from that day to follow up with answers. Thank you, and the committee is adjourned.
Thank you, sir.
Yes, ma'am.